Welcome to this lecture on SOX compliance and internal controls. In this session, we'll explore how the Sarbanes-Oxley Act transformed corporate accountability, why it emphasizes strong internal controls, and how organizations comply with its key requirements. The Sarbanes-Oxley Act, often called SOX, was enacted in 2002 in response to major corporate scandals like Enron, WorldCom, and Tyco. These scandals exposed massive financial frauds caused by weak internal controls, management misconduct, and auditor negligence. SOX was introduced to restore public trust in corporate governance and protect investors by improving the accuracy and reliability of financial reporting. At its core, SOX establishes a legal framework that holds both management and auditors responsible for the integrity of financial statements. It mandates stronger oversight, enhanced disclosures, and independent auditing practices. While SOX applies primarily to you, as public companies, its principles have influenced corporate governance worldwide. Let's break down some of SOX's most significant sections related to internal control. Section 302 requires top executives, typically the CEO and CFO, to personally certify the accuracy of financial reports. They must confirm that they have evaluated the company's internal controls and disclosed any weaknesses or fraud to auditors and the board. This creates direct accountability at the highest level. Section 404 is perhaps the most critical. It mandates that management establish, document, and assess the effectiveness of internal controls over financial reporting, ICFR. External auditors must also independently test and report on these controls. In other words, organizations can no longer rely on trust alone. They must demonstrate control effectiveness through evidence. Section 409 requires real-time disclosure of material changes in financial conditions. Companies must communicate significant events quickly and transparently, preventing the concealment of critical information from investors. Section 802 introduces severe penalties for destroying, altering, or falsifying financial records. It reinforces the need for proper documentation and record retention policies. Together, these provisions make SOX compliance a cornerstone of modern internal control systems. Implementing SOX-compliant controls begins with management's commitment to a strong control environment. This includes ethical leadership, clear communication, and a culture of accountability. Organizations typically start with a top-down, risk-based approach, identifying significant accounts, processes, and risks that could materially affect financial statements. Once risks are identified, the next step is designing and documenting key controls to mitigate them. These may include authorization procedures, reconciliations, system access restrictions, and segregation of duties. Documentation is essential. Every control should have a description, responsible owner, frequency, and evidence of operation. Testing is the next crucial step. Internal audit teams or external consultants evaluate whether controls are operating effectively. Any deficiencies are classified as control weaknesses or material weaknesses, depending on severity. Management must disclose material weaknesses in its annual report and take corrective action promptly. SOX also emphasizes the importance of independent audit committees. These committees, typically composed of board members, oversee financial reporting and internal control processes. They ensure that management and auditors remain objective and that findings are addressed appropriately. Technology plays a vital role in maintaining SOX compliance today. Automated systems can enforce segregation of duties, track changes in financial data, and generate audit trails for review. Continuous monitoring tools provide real-time visibility into control performance, reducing the risk of surprises during audits. The benefits of SOX compliance go far beyond regulatory adherence. Companies that maintain robust SOX programs build stronger investor confidence, enhance operational efficiency, and reduce the likelihood of fraud. Over time, these organizations tend to outperform peers with weaker governance. However, SOX compliance is not without challenges. The process can be resource-intensive, requiring coordination across departments, regular testing, and meticulous documentation. But with experience and technology, many organizations have optimized their programs, integrating SOX controls seamlessly into daily operations. Let's consider a real-world example. After SOX was implemented, many companies initially struggled with compliance costs. Over time, they discovered that well-documented, automated controls actually improved their processes. For example, by automating financial reconciliations and access reviews, companies reduced manual errors and audit preparation time. What started as a legal requirement evolved into a strategic advantage. To summarize, SOX compliance and internal controls are about more than avoiding penalties. They're about building integrity, transparency, and accountability into the heart of an organization. The Act made management personally responsible for financial accuracy, strengthened the role of auditors, and created a lasting culture of corporate responsibility. In our next lecture, we'll explore fraud prevention and detection, examining how organizations design internal controls to identify and stop fraud before it causes harm. Thank you for joining me in this session on SOX compliance and internal controls.